please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. In the red for all the benchmark indices. Bear in mind the Asian market context. Hang Seng is now down close to about 100 odd points, and even the other markets like the Korean market, the Chinese markets are under pressure with cuts of close to about 0.5%. But for yet another day, the IT index, so the IT stocks are holding up on the back of the rupee weakness. Anand Deshpande, the founder, MD and CEO of Persistent Systems, and Abhishek Bhandari, the senior research analyst at Macquarie Capital Securities, join in for a discussion on the demand trends, the impact of the rupee weakness on the Indian companies. Mr. Deshpande, good morning, and let me start straight away with you. When we last spoke to you, this was post your Q1 numbers, you indicated that F519 margins will be higher than F518 margins by close to about 100 basis points. So that was your guidance. But at that time, the rupee was close to 68. Now we're talking about the rupee at 72, 73. Is there an upward revision in your margin guidance for F519?
To make guidance changes at the moment, and we are still watching the difference in terms of what is happening to the rupee dollar conversion and how that will last. To be very direct in terms of what difference it makes, if you look at like-to-like comparison, if you see a 1 rupee difference between dollar and rupee exchange rate for us, it converts to about 25 basis points or 0.25% on the EBITDA level. And then beyond that, it depends to some extent on the forex hedges that we have and what comes out of it. So it's fairly complex in terms of exactly determining the benefit from 1 rupee difference in terms of the dollar to rupee difference that we get.
Actually, fair point, Mr. Deshpande. That was going to be my next question. What percentage of your flows are hedged?
So normally what we have is that about 60% of our expenses are naturally hedged because they are not in rupees, and the earnings are there. And for the rest of the money, we have been buying 1-year forward covers for about half of our potential expected earnings in a sense. So about half the money is hedged for a 12-month forward cover.
Okay, so net, if the rupee stays at these levels of say 72.5, will there be a positive impact at the EPS level?
Yes, there will be some positive impact, but to some extent it has to do with the levels of hedging that we have. We do very vanilla 12-month forward covers, so to some extent we'll know more as we go along. But at this moment, if it stays here, definitely we will see a benefit on the EPS level by the end of the year.
Do stay on, Mr. Deshpande. We have Abhishek Bhandari of Macquarie as well with us. Abhishek, you must have looked at the hedge percentages of a whole range of companies you track. Who's best placed to benefit from the rupee fall?
Yeah, good morning, Lata. Actually, the range of hedges varies significantly across the whole sector. If you look at some of the large caps, they have hedges between 1 to 3 quarters, in some cases even 4 quarters of revenues. Whereas some of the mid caps like L&T Infotech particularly has more than 1 year of hedges given their hedging policy. So, there's no direct answer, honestly. The range varies significantly. Among the large caps, the ones we think will benefit the most because of rupee depreciation would be TCS. And in the mid caps, we see a significant improvement for Persistent. I think the guidance of 100 basis point margin improvement should see somewhat upward bias given the way the rupee is.
Abhishek, good morning. So that's on the rupee depreciation and the benefit to the companies. You also chat with all the companies. Give us a sense of, has there been any change in the demand commentary from the companies? Has it improved, say, compared to the start of 2018? And is it likely that F519, F520, or from here on, there is going to be an acceleration in revenue growth for these companies?
Actually, you're right. Some of the commentary which has been coming out of the companies over the last 2 quarters has seen a significant amount of positivity. In fact, in the note which we put out early this week, we had tried to tabulate the change in commentary not only from the top Indian IT companies, but also from the likes of Cognizant, Accenture and Capgemini. And it really looks like there seems to be a revenue acceleration coming through. If you look at some of the other broad indicators for the industry, the net hiring has started picking up after being very soft for the entire FY18, which is generally a lead indicator of revenue acceleration. The large deal momentums has not only come to TCS, but now we've started seeing a growth momentum coming in also for Wipro with the $1.5 billion deal, and for Infosys, the first quarter deal momentum was 70% up year on year. And most of the mid-caps also have been talking about a pickup in the demand environment. So I would say net-net, yes, there is positivity around the sector. FY20 should see more acceleration compared to FY19, because so far the real benefit of US tax rate cut on expenditure on capex in US companies is yet to come through, which generally is a good thing for companies on the even IT sector.
Okay. Mr. Deshpande, there have been some, expectations or even belief that IT companies are hiring more. What's the situation at your end? Has there been more than expected business and therefore more than expected hiring?
Yes, we have increased our hiring again in the context of a month-to-month hiring that we have been doing. Some of it is, of course, anticipating forward business and some pipeline demand requirements that we do see. The challenges, on the other hand, has been that the nature of work is shifting, and that requires more specialized skills and people who have, full stack programming capabilities rather than the traditional, dev QA resources that we were hiring in the past. So hiring has become harder as well in some sense.
Mr. Deshpande, in Q1, your services business, digital as well as Accelerite had declined on a quarter-on-quarter basis. In the current quarter, has there been a pickup?
Again, it's still early to say. We should see some pickup in those numbers this quarter for sure, but it's hard to predict. And also, when you look at our numbers, a lot of them, we have a lot of seasonality in terms of the odd and even quarters in our IBM business, which constitutes a large percentage of our variable and IP revenue that you would see in your numbers. So we had a good Q1 on that account. The Q2 will be soft on that. So when you total it all up, it's hard to exactly say how much the growth you will see at the end of the quarter.
Okay. Final question to you, Abhishek. What is your sense? Which are the companies that are doing the hiring, and therefore, where do you have a positive opinion?
Sure. So net hiring has picked up across the board. It's not only limited to a few set of companies. I think especially if you look at in terms of TechM, which was on a declining mode as far as headcount is concerned last year, has again stepped up the hiring. There is a pickup not only for TCS, Infosys, but also in the mid-cap side. So it's a broad-based, growth which we're seeing across the sector. And as Anand mentioned, I think companies are preparing themselves for better demand environment, and also keeping in mind that hiring on time is becoming more and more difficult, especially around new technologies. Coming to the, where we see a good growth momentum continuing, I think among the large caps, we are seeing the highest growth coming in the TCS business, largely driven by some of the large deals what they've got in last 6 to 9 months. In TCS in particular, we expect it to touch double-digit growth purely on organic basis, which will be by far the highest among the large cap names. Most of the mid caps will have almost, more than 12 to 13% growth, which will be 1.5 times of industry, and almost touching 18-19% for likes of L&T, Infotech, and Mindtree. So those are the guys who will have, the strongest growth coming up. In terms of EPS growth, the EPS growth actually will be higher than the revenue growth for the whole industry this year, partly because the currency benefit will lead to a better EBIT growth than the top line. And in that context, some of the large caps might even post 25% kind of EPS growth, which in particular TCS.
Wow. Okay, that's a big base on which to get 25%. Mr. Deshpande and Abhishek, thank you very much indeed for joining us in all the gloom about higher crude prices and higher yields and cheaper rupee. It's good to hear that some people are benefiting, and more importantly, hiring. I mean, let us remember that higher rates are coming because growth is good in the United States, and good hiring is definitely good news.
Okay, let's move on then. Stick with technology. American tech giant Apple is expected to announce 3 new iPhones today at its Gather Round event. It is likely to launch a 6.5-inch device with an OLED display, which is an upgrade to the current iPhone 10 with a 5.8-inch OLED display and a lower price 6.1-inch handset with an LCD screen. Along with the iPhones, the company is also likely to make announcements on its other products such as iWatch as well as AirPods. Well, iPhone 10 was at 1 lakh when converted into rupee. I wonder what these products are going to be priced, especially now when you have to import it with the rupee at 73.
See, that's the power of brand. I mean, Indian exporters look at the rupee and hope that they can export more. But an exporter like iPhone doesn't care about currencies. They have their brand. So those who want to buy at 1 lakh will buy at 1 lakh 10, I guess.
It's an addiction, as they say.
Yes, but for the moment only, I would believe that the rupee is going to be a very big deterrent, and at least some people on the margins are going to fall off, which is going to be good, of course, for our trade deficit. Speaking of which, we have to take a break and come back with the person who is creating a lot of trouble for all of us, Manisha Gupta, and the latest commodity trades.
Welcome back, and what a run-up we continue to see in case of the crude oil prices. 2% gains in overnight, and we are looking at 1% of a follow-through buying in the Asian markets as well. And that's exactly what you have seen. The Indian prices mirror a percentage point of gain, and 5,100 is in sight there. Plenty factors which have been supportive and continue to take the crude oil prices higher, starting right with the US weekly inventory data, which is expected to show a decline of 8.6 million barrels, and that is what has been supportive. And add to that the Iran sanctions, where we already have seen 28% of a decline in Iran exports since the month of April. That has added to the premium here. And then, of course, there is a Hurricane Florence, which will make a landslide on Friday, a second strong one in this season. That is supporting the prices. There are statements from EIA, Russia also putting out supply concerns as we go ahead into 2018, and all of that keeping the prices on the higher side there. The strength in US dollar is something that has continued to weigh on the gold and silver prices, but it is the Indian rupee depreciation which is supporting the Indian prices here. So quite flat, but we are marginally into green as far as the gold and silver prices go. There's a bit of a technical resistance as well when you look at the global gold prices, where $1,200 per ounce has not been able to hold on, and that is what worries the buyers in case of the precious metal space there. The industrial metals, in the meanwhile, have been all over the place. We have seen profit taking come in for Shanghai metals. This is after China tells provinces to put its own restrictions as far as the metal and pollution go. So we have seen declines come in for that. But the LME prices have seen some bargain buying on the lower side. We saw the nickel prices decline to a 6-month low. Zinc was trading at a 3-week lows. Copper hit a 3-week lows in the New York session as well yesterday. And from those levels, we have seen some buying come in on LME. And that is what you can see on your screens as well. Strategies then, and we have them from Grow Value. They have a sell call continuing for the industrial metals. For copper, they're looking at a downside of 407. They also have a sell call continuing for nickel. 860 is what they're looking for that one in their prices.
Okay, thank you very much for that, Manisha. And coming back to equities, at the moment, it's not looking like there's too much relief on the mid-cap space, but we are seeing just a dash of green on the Sensex and the Nifty. Well, it does look like it's going to be a very interesting day, and we'll have lots of ideas coming up for you on Chartbusters. But as we wind down on Bazaar, let's leave you with a very important voice ahead of the 10th anniversary of the collapse of Lehman Brothers. I caught up with Harvard professor Kenneth Rogoff to take stock of what he makes of the Fed's rate hike trajectory. Watch his words very closely. It looks like an ominous warning.
I think the U.S. is really booming, and eventually it's going to start bringing so many people into the labor force and pushing up productivity, but it's also going to be pushing up wages, and the Fed might have to start hiking more aggressively. I don't see that in the near term. I think the markets have been too sold on the idea that growth is dead. This phrase, I don't know if you ever used it, secular stagnation. My colleague Larry Summers, they've been oversold on this idea. A lot of what we experienced was the financial crisis. It takes a decade to get out of a financial crisis. It doesn't, but they end. They eventually end. It doesn't mean it's going on forever. And I think we're in that phase where growth is picking up, investment's picking up,